All right, good morning.
Thank
Thank
you
you
very
very
much,
much,
Elibet.
Elibet, who have joined us. Let's just give ourselves about 3 minutes to have some more people join the call, then we can start. In the meantime, you can be pondering over the title for today's presentation. It's 9:10. Good morning once again, everyone. My name is Ernest, and I'll be moderating today's session. It feels great to have you all here today with us on the October edition of the Market Color. And today's focus, as you can see on our screen, is a subject that's increasingly becoming very important for portfolio managers, pension trustees, and then investors across Ghana. There's actually an old adage that says variety is the spice of life, but we can all attest to the fact that there's still more to do when it comes to asset allocations in Ghana. Hence the topic, beyond traditional assets, what are the opportunities inherent in alternatives? This is the main theme for today's presentation. However, as usual, we will take you through some salient points within the market over the period. For those joining us for the first time, Market Color is actually a grounds or a space that brings together industry players, colleagues, our friends of the market to discuss various trends in the market and then also exchange ideas that we believe would shape the investment space of Ghana. So feel at ease, enjoy the presentation. We expect you to contribute or be engaging after the presentation with your questions or contributions or clarities that you may need. The floor will be open at that point. Today's session will be led by Enoch Sunkari, who is with the Black Stars Analytics Research and Insights Desk. He's going to take us through the October 2025 Market Color Report and would highlight how Ghana's fixed income and equity markets have performed this year and why alternative assets are beginning to gather momentum locally and also globally. In the course of the presentation, you can expect macro and market updates, how falling yields have renewed interest in risk assets, and the growing case for diversification into alternative assets. And like I've mentioned, after the presentation, the floor will be open for Q&As. If you would want not to forget your questions or lose your thoughts, there's a Q&A session or a box, and then also the chat box is also available, which you can actually utilize. Just write in your questions or contributions there. We are going to read it, and then we would all discuss them and also attempt to answer some of your questions. So without much ado, I would invite Sunkari now to take off.
Hi, good morning, everyone. I hope I can be heard and my screen can be seen.
Yes, Sunkari, you can be heard. Your screen can also be seen. So
okay, sure. Hi, welcome back. In today's session, I would like us to talk about alternative investments and then and alternative investing. I know you are already having the thoughts, kind of like alternative to what? I know. Hold that thought. It's a good question, and I hope I have some of the answers in the next few minutes. So let's start with a couple of very basic facts where I think you know, and I think there's no disagreement on them. The first is that much of investing as we know it, either in books, lessons, or classes, or in our interaction or market participation, have been directed to two classes of investments. First, which is publicly traded stocks, and then second, which is publicly traded bonds with cash as a buffer. Cash being cash invested in something riskless and then liquid. But by doing that, what we've observed is that we've ignored, and then I think that's the second truth to these basic principles I wanted to mention. A vast majority of the investing universe, we've ignored private businesses, we've ignored venture capitalists and then private equity investors, which happen to provide capital in these venture spaces. And then we've also ignored assets which are not actually traded, real estate, collectibles, and even crypto. And then even to the far extent, we've ignored strategies that short stocks rather than go long, because most of traditional investing, as we know it, has been directed at long only investing and holding stocks or holding bonds, not really shorting them. And then that's where I'll be mentioning a little bit of names like hedge funds. And then for these alternatives, one thing is that they've been around for a very long time. They've been around forever, but much of their life much of their life, especially when you look at it in the last century, they were only accessible by a very small subset of wealthy individuals or a small group of institutional investors, and also not even in most markets, especially frontier and emerging markets. These kind of investing classes or principles or strategies has always been with more advanced or developed markets and not in the frontier markets. But we've gotten to a point and time in the investing universe that we think we need to start rethinking some of these things. Without giving too much away, so when you look at it in the last 2 decades, alternative investing has been sold to only mainstream, especially just institutional investors, but not in our part of the world, because I mean we are in frontier and we still face a lot of basic investing challenges, which some of these strategies may not really be easy to come by or to access. But without giving too much away, though, I think the sales pitch for alternatives is a very simple, and the first part of the sales pitch is based on a very simple portfolio theory maximum, right? Which is adding something that is less correlated with what you hold already, especially, for instance, stocks or bonds. And then the belief is that once you get hold of something like that, it can create a better risk return trade-offs, portfolio variation. And the second argument is a little more subtle, which is you are more likely to find market mistakes in the alternative investing universe, especially in for instance, real estate, cryptos, and private assets, which we are going to talk about in the next few sessions. So when you look at even when you come back to Ghana, what we've realized is that most of the investing is just between a trade-off of bonds, equities, and in cash. And then this year has been one of the years that we've seen this kind of like play out, when we saw investors trying to move towards reallocate to high yield assets because of what was happening in the market. So earlier this year, when you look at the whole of last year, 2024, we saw that at the auctions where most of these investors play in, where they go in for their T-bills and then fixed income, mostly fixed income securities, because we know the bond market is not really active as of now, but so most of them were really playing in the T-bill market. So when you look at this chart, is showing the Treasury bill auction results from last year, 2024 to 2025. When you look at last year, what we realize is that government was coming to market and picking almost everything that was tendered in the market, leaving little or rejecting just a small number of the base. But this year, when the year started in January, we realized that the story changed from there, and we saw how investors reacted to such a play. We saw that a large number of bids at the auction were actually rejected than it was when you compare it to last year, the whole of 2024. So what we are seeing here is that at the auctions, we saw a huge rejection in February earlier this year, and then that was when we started seeing yields dropping a bit slow. It was dropping slowly, and then we realized that the rate of decline was accelerating. So when you look at the total bids that were rejected earlier this year, or this year to date, when you combine them, government have rejected about nearly 2.2 billion. I know people have different views about this, talking about government not spending. That is the reason why they have the room to really do that. And so also thinking that maybe government is actually pressuring the yield curve down so that they can normalize the curve and come back to the bond market. But what we saw here was that the government ability to reject, or government being able to reject these bids, were able to compress the yield curve down and triggered short-term financing or triggered short-term financing pressures down, and then we saw yields going down. And then in the same breath, we saw investors who normally play largely in this market, in the government of Ghana treasury bill market. We saw as yields began to trend downwards, we saw how they moved to participate hugely in the Bank of Ghana side of the divide. So we keep seeing large base moving towards the central bank side of the auctions because yields were dropping on the government of Ghana. So when you just look at the blue line here, which shows the 91-day interest rate, which is a volume weighted average, we did just to illustrate this because we wanted to have a view of that. What happened on the market, both the fiscal side of the divide and the monetary side of the divide in months. So we did the volume weighted average of these yields and where these bases were cleared out. And when you look at the 91-day bill papers, which is the blue line, the interest rate, you realize that somewhere in January when it started dropping, started dropping gradually, but the Bank of Ghana side of the divide rate was still elevated, and we saw investors moving towards that side, tendering base started increasing on that side of the divide. But what we saw later in the year, somewhere in the middle, June, July, when Bank of Ghana also decided to lower rate, they dropped rate, and then there was a huge gap, there was a huge spread before that, but when they dropped rate, it closed the spread between what investors were getting from the government side of the market and also from the Bank of Ghana side of the market. And then what we saw was that we saw investors trying to move away from both the government side and then also the Bank of Ghana side of the market. And then we saw trading volumes in the bond market beginning to pick up, and then this was even you may bring in the conversation of the duration compensation factor, but what we saw was that maybe if investors were just trying to lock in on this rate because they were getting better at that side than what they were getting on both the monetary and the fiscal side of the divide. And then there's a saying that capital actually moves where returns lead, right? We saw that investors, they're always on the chase for yield. Bank of Ghana were offering higher rates. They were heavily invested in that side of the divide. When government dropped their rates, we saw that they moved to the Bank of Ghana side of the divide because Bank of Ghana was relatively offering a higher rate. And then when we saw Bank of Ghana drop their rate, we saw the bond market also beginning to pick up from there. And then later on this year, we saw that the equity market, not even later on this year, we've seen that this year, the whole of this year, the equity market is on fire. We've seen the equity market on a very bullish run this year. And then it is, it's very evident for those of you who hold equities, you can testify to that. You've seen that we having year to date, we don't actually have laggards on the market. Almost all the stocks that have moved this year in profits. And then when we look at this year alone, January, the market did about 7%, February 8%, then March 10%, only dipped in April this year. And then after that, it has been on an upward trend. Even when you look at the average return on the market, it's up almost 73%. And then this performance drew the attention of investors, right? Because as I said earlier, capital actually moves where returns lead, right? When we saw rates dropping on the government side of the divide and as well as the Bank of Ghana side of the divide, then we saw a shift to bonds to lock in on the rates, even though there was the duration compensation that have to be had. And then we saw that the equity market also had a spillover of that effect because investors were actually on a search for yield. And we saw the market rally, and it's on a bullish run this year so far, with almost all stocks that have really moved this year up in profits. And what we realized was that we saw a spillover of that effect of low rates on both sides of government and in the fiscal government and the Bank of Ghana side, and then we saw a spillover of that into the equity market, because what we realized was that Bank of Ghana actually drove their rate in July, and in July both government and then Bank of Ghana rates were so low, and we saw at one of the highest turnover in the equity market in July. We saw when you look at it, this is just a simple calculation of the trading volume divided by the number of trades that happened on the market over the period. If you look at the whole of this year, there was not that much activity in the equity market. But when government and Bank of Ghana side of the divide collapse rate in the same month, somewhere in July, we saw a huge turnover in the equity market. When you look at what having happened, we realize that even some of the investors, it's not all investors that are allowed to participate in the Bank of Ghana auctions. It's primarily banks, right? But what we realized was that in between June and August, of which we have data to attest that we don't have data for the past months of what has been happening. We only have for June and August. And when we look at the shift in asset allocation on that side of the market, the equity market, we realized that banks actually increased their position about 897.6 thousand shares on the market. And we realized that some other investors also reduced their positions in the same period. What was also noticeable was the foreign investors realized that they've trimmed down their position. I think this is really on the back of currency and then people exiting, foreign investors trimming down their positions, right? When you listen to the Bank of Ghana Governor IMF speech, you realize that he actually mentioned that the reason why we FX have to FX pressures, FX actually depreciated somewhere in the middle of the year, June, July. He actually mentioned that the reason for that was that we had some foreign investors, both equity and fixed income, that wanted to exit the market and then trim down their positions, and then they needed to supply meet their FX needs, and that was the reason why we saw CD depreciating in those periods. And then when you look at the data of the investor holdings of equity in our equity market, you can actually see that between June and August, that event actually happened. We saw that they trimmed about 10.4 billion of their positions. But what we are paying attention here to is the banks, because both sides of the divide, yields were low on all sides. We saw banks actually increasing their position. This is a little when you look at the overall holdings on the equity market, but you realize that they were actually on a chase for the yield we are talking about. So when you look at even on the broader market, looking at all investors together, when you realize that this year, not even this year, later somewhere last year, up to this year, we've seen that there's a lot of pressure on the market, right? We've seen a lot of bids on the market. We've seen a lot of buying pressures building up on the equity market, because T-bills are not offering the yields that they think is worth their money, and then they are on a chase for yield, moving from the Bank of Ghana side to the government side, to secondary market, and then they spill over into the equity market. We will just push the market net bid over time, over a very long time now. So when you look at even September, as at Friday, we had about 1.1 million outstanding bids that are still on the market. This is also one of the challenges that we face in our market. There's not actually liquidity. Even if you really want to get hold of these kind of securities or equities or shares on the market, you still have to go through the liquidity challenge that we've been talking about for a very long time. And then this is also another chance or a hint that we really need to look elsewhere, because if Bank of Ghana side of the market, which was offering better return for your money, was getting better payoff for investing in these fixed income, both the government side and also the Bank of Ghana side is no longer offering a better payoff for your money, and then you come to the equity market and then you face another challenge of not even with the money you are not able to access these kind of equities. It is also going to be an actual problem. I mean, the market is booming, but you are not able to benefit from that. And this is the opportunity for us to rethink what we need to do to make sure that there's enough options on the market for every single capital that needs to be allocated. So when you look at it, when you look at this shift moving from Bank of Ghana to moving from fixed income generally to equities, and then when you look at even the payoff over time, when you look at the equity market, from 2015 to 2020, it has had a very, very, very worst performance over when you look at it relative to bonds. When you look at the average return on the market from 2015 to 2020, when you look at you realize that fixed income actually outperform equities. And then, but when you look at just the past 5 years, we've realized that equities are also doing well. As I said earlier, when the returns are good, you see capital chasing, right? When you look at the same scenario over bills, you realize that the last from 2015 to 2020 has been a bad year for equities. It has been favoring T-bills. And then when you look at just the last 5 years, we realize that equities are also on a rally. But there is a problem with this. The reason why I'm showing this chart is that when we are fixed between two asset classes, bond, equity, and we keep moving capital from one side to the another, where return is not promised, it is actually a time for us to rethink what we should, what other investment classes should be added to our investing landscape. So even, I mean, it's obvious in the subsequent slides, we're going to see the reason why the equity market performed badly from 2015 to 2020 and how it is booming now. But I have a view that unless the equity market is actually repricing, I don't think it's going to be a good run overall. And in test cases, and when we see that of the equity market, and then when in such cases, when we see both equity market and fixed income moving together, offering returns moving in tandem, what normally happens with a little crisis is normally disastrous. I mean, we all know that it should not be, even if it moves together, that it should not be that strong. But in a time when we see equities and bonds aligning, it is a time for us to really be cautious, because it may not all be gold. It may not be all that is glittering that is gold, right? What we are seeing here is that we've seen that over the past 5 years, we've seen that, I mean, you know the challenges we've gone through in our bond market. If you're on a chase for yield and you know that the bond market have done something to you, and then you've moved to equities, and then equities were offering a good return, and right now what we are seeing is that all bonds and equities are performing well, and then it becomes a problem, right? It is no longer the conversation of whether I should divide capital among these two, because both of them are actually doing well. It's now a time for you to be cautious, right? So when you look at when you look at even our market, the people with the capital, which is largely in pension funds, right? When you look at pension funds allocation of assets in our market, we've seen that when you look at the private pensions, it's mostly tied to our fixed income securities with a little concentration on equities, and then also alternative assets, right? So when you look over time, it has been a mixture of bond equity, and then when you look at our tier one, which is managed by Senate, it's only Senate that has even played a little more in the alternative aspect of the market. But when you look at private pensions, as I showed earlier, there's a little allocation to alternatives. It's just being bond equity and bond equity. But what happens when bond and equity moves together has a time that we are in now? When you look at 2025, this year, as I have showed, the bond market is recovering, and even though we've seen yields dropping, but we've seen that the bond market have recovered, and then the equity market is on a bullish run, and then we've seen both equities and bonds moving together. As I said earlier, as the typical strategy has been a shift between equities and bonds, but when bonds and equities move together, it's a time to be cautious, right? Because when we realize that in 2021, when we had the last time we had bonds and equities moving together, the year that preceded, a little crisis that we faced in 2022, we saw what happened. We saw everything down in the market, both equities and bonds. We saw what happened that time. But in 2017, when we had both such a bullish run of bonds and equities, and then we saw what happened with the financial sector cleanup, right? In 2018, we saw that we started shifting. And then in 2019, we shifted somewhere here. In 2025, it's kind of like something is repeating again. And this is where I think we need to be cautious, right? In 2025, what we are seeing is that stocks and bonds are aligning, and we're seeing everything move together. The question now is, what if we face another crisis like we've had in the past? Because we've seen that when we have such a bullish run of both equities and bonds, because all our investments are tied to bonds and equities in the market, when we have such a bullish run and then a little tension or a little crisis, we see what normally happen. In 2025, when we look at both markets, both bonds and equities, we are back in the same part of this chart. The question is, what if there is something ahead of us? Are we going to face the same problems, complain, and go back, do the same things, or what is going to actually happen? Just to give you a view, the last time we had in 2021, as I showed, when we had a little crisis, because both bonds and equities were moving together at the time, we saw what happened when there was a little crisis. We saw government bonds coming all the way down. We saw financial stocks. And in financial stocks, these are your banks, and these banks are concentrated in these same fixed income securities. And your mutual fund, your mutual fund is also a mixture of these two classes of assets. And you saw what happened when we had a little crisis in 2022. But preceding 2022, we saw where the market was. We saw both bonds and equities on the move together, on a bullish run, on a bull run for a very long time. And this year, 2025, what we are seeing is that we are back to the same side of the market where both bonds and equities are moving together. The question is, should we just be moving between these bonds and equities? Is it not the time for us to have a conversation and push for other asset classes or other investing strategies on the market so that we don't really put ourselves in such a space? When you look at the our fiscal income maturity profile in 2027 and 2028, there's going to be a huge liquidity that is coming to the market. Our 71.4 billion of these pension funds and bonds are going to be maturing, and this liquidity is coming to fund managers. Are we going to reallocate back to bonds and equities on the market, or is it not a time for us to start having conversations around new vehicles on the market whilst we await such a capital in 2027 and 2028? And this is what brings us to what we think should be a conversation going forward whilst we wait for such a huge liquidity payout in 2027 and 2028. As I said earlier on, it is actually true that most of investing lessons we've had, or what is practically done, is been directed to only those of us who invest in stocks and bonds, and mostly with long-only strategies. And it's also true that in the process, while we are doing that, we've ignored a vast majority of the investment universe from other asset classes like real estate, collectibles, cryptos, to private holdings, which is mostly your VC and your PE, to strategies that other investment strategies that are not long only strategies, and also to the use of derivatives, which are primarily done by hedge funds. So, but what we've seen is that in the last 2 decades, we've seen alternative investment entering the mainstream, first with choices which are only directed to institutional investors, but more recently, we have seen a little bit of offerings to individual investors. I mean, maybe not in this our market, but we've seen how it's going in other markets, and it is a time for us to maybe start having the conversations and see how we can bring some of those diversity into our market. As I said earlier on, investment classes investing has always been a divide between fixed income securities as well as equities, and then cash, right? So I would like us to start with a typical investment basics, right? Once you walk into any investment forum, what you are told is that you're supposed to allocate your capital or your portfolio between publicly traded stocks and then publicly traded bonds. And how much goes into each will be determined mostly by your risk aversion, right? If you are risk averse, I think you will invest more in bonds. If you are less risk averse, more in stocks. And also, you're also allowed to bring in market views. If you think stocks are overpriced, you might allocate less to equities and otherwise, and then maybe if you think bonds, then more to bonds. But normally you start with the bond equity mix, and now of course mostly you hold cash, right? And cash into play because it acts as a buffer, and it plays primarily, I think, of my view, is maybe 3 roles, and one is it meets your needs for liquidity, which is if you need something in the next month, the next 6 months, you don't want to put it in stocks or bonds where you might not be able to cash out as quickly without giving out something. And the second, I think, is that cash also allows you to really adjust your risk aversion component of your portfolio. The less risk you are, you want more, you want to take more, you want to take more and then hold more cash. And then the third, I think, is you can bring your market timing views to play, right? If you feel that both stocks and bonds are overpriced, what do you do? I think you will just hold more cash, and that is a typical portfolio allocation. And I have to be quite honest, it is a pretty flexible framework because mostly it allows for different views and markets. If you don't want to time market, you basically pick an asset allocation, like maybe the 60-40 mix, which are mostly classic things that we've been told, and you stick with it. If you're a market timer, you might just adjust your allocations of stocks and bonds based on your market timing views. And in doing that, you can also bring in your investment philosophy. And if you're a value investor, the way you pick your stocks will be very different from if you're a growth investor. And if you're a passive investor, you can you easily just go with your mutual funds and your ETFs to deliver all the results within this typical framework of bond equities. But let's face it, of all the differences across investors in this typical framework, will be in the mix of stocks and bonds, and then the cash you hold, and how you pick the individual stocks and bonds to invest. And by doing this typical framework exercise, we've ignored for a very long time a large component of the investing universe, and then which are mostly when you look at it, we are mostly ignoring private businesses, and you may say why? Because most of them are not publicly traded. We're also ignoring the short selling strategies I've mentioned in the investing universe, and we are also we are also ignoring asset classes that are not traded, such as real estate, cryptos, and collectibles. And in fact, the best way to see what the choices are in the alternative investing universe is to look at these three dimensions, which is the long short division, and then the public, private, and also the untraded assets alternatives. With the long short divide, which is mostly institutional investors, which includes your mutual funds, pensions, endowment funds, and then these funds mostly are restricted from taking short positions on investment, with exceptions sometimes kept out for only hedging. But for close to a century, mostly in developed markets, we've seen hedge funds have been given the freedom to actually short traded assets. But while they do not always use that power to short to the benefit, I mean, it is undeniable that even though you may not use it, but it is undeniable that having that power allows an investor to actually create a return distribution in terms of expected returns and volatility, and maybe other distributional parameters that are different from those that are faced by long-only investors. And then within the hedge fund universe, there are diverse strategies that not only augment the long only strategies, right? But also invest across multiple markets, stocks, bonds, convertibles, and other geographies, right? And what we've seen the closest to is in the opening up of the derivative market, which has also allowed some investors to create investment positions or structured products that use options, futures, swaps, forwards to create cash flow and return profiles that diverge from stock and bond market. I think for when it comes to that side of it, we've seen that only forwards, we've seen forwards in our FX market, and then maybe we may think of looking at other ways to bring that kind of strategy or technique into the other side, both equities and bond market. And the other side to look at alternatives is also to the public and the private divide, right? While much of our attention is mostly spent on publicly traded stocks and bonds, I think there's a large segment of the economy that is also composed of mostly composed of private businesses that are not listed and traded. And many of these businesses are owned and funded by their owners. But a significant portion of these businesses do sometimes need outside capital, sometimes outside equity capital, and then maybe and then when you look at it historically, there have been two providers of this, right? For young private businesses, and then especially those that aspire to become bigger and eventually go public, it is mostly venture capital that fills that void, and which covers this spectrum from mostly ideal companies with a little bit of angel investors to growth capital for young business. But for most established businesses, some of those need capital to actually also grow, and some of which have owners who want to cash out. So the capital comes from private equity investors. And then on the debt front, we have the public debt and then the bank debt market, which is supplemented by private credit, where investors actually sometimes pool funds to lend to private businesses that need them with sometimes good and maybe negotiated risk. We've seen, I think recently we've seen one of the private debt fund that came to market. I mean, I think we've had several of them, but or maybe we are not just aware, or the sales pitch is not really that vibrant for us to know. But I think we've seen one from Stanbic looking to take funds from investors to invest in some of these businesses I've mentioned. And then the other divide, which is the untraded assets, and much of it is mostly real estate. When you look at it, for much of the 20th century, real estate remained outside the purview of public markets, with only a segmented investor base and illiquid investment. And then most of these investments actually require localized knowledge to actually maximize or play on that turf. And then when you look at that sector, real estate, REITs, they started to change real estate actually investment vehicles started to change by the creation of what we call the real estate investment trust in the early 70s, and then right now we've seen a little bit of it being in markets actively invested by investors. And then the other class of untraded assets we've seen is also I would like to call collectible asset class, which spans a wide array of investment, most of which generate little or no cash flow, but mostly drive their pricing from scarcity and enduring demand. The first and perhaps the longest standing collectible is gold. I think is gold, which are kind of like which is a kind of like a draw for investors during crisis, and then when they lose faith in fiat currencies and governments, or maybe in times of uncertainty. And the second arch, I think, is art, which is always range from paintings from Middle Ages to digital art. We've seen somewhere 2020, 2021, we saw how there was a spike in non-fungible tokens, popularly known as NFTs, on the market. And that also, when you look at all of these, they presumably offer owners not just the financial returns, but also sometimes emotional dividends, which is kind of like, but when you look at it, at the risk of raising this kind of investment classes or investing in some of these classes, I will actually argue that most often, much of the crypto space, especially Bitcoin, also fall into this grouping of a combination of the scarcity and trading demand determining the pricing. So when you look at the alternative sales pitch, the main idea has always been that you should just have something that is have a low correlation, as I've mentioned earlier on at the beginning of this session, that the convincing part is always that you should add the convincing pitch of adding alternatives is mostly always an idea of adding something that has a low correlation with what you already hold. And then the payoff is normally a promise that once you add alternatives and you diversify risks, and then maybe you stabilize returns through the low correlation with traditional assets that it have. And then the next sales pitch point is normally that most of on top of the low correlation, there's also an excess return on alpha that can be generated by exploiting market inefficiencies, and then and also maybe for best managers, they're able to kind of like maximize on this inefficiencies to make this extra alpha. And then the last point that we've seen coming in most recently, which has been the impact argument. Most people really think that maybe for this, not only for the purpose of returns, but we should invest mostly to make purpose. But I think most of these, we're going to have a deeper look at them. So when you look at the correlation benefit, I've done the analysis. We've done the analysis using the past 10 years. When you look at the past 10 years, when you look at the correlation metrics of Ghana equities and bonds to all the other classes of assets, whether the bond equity mix or the alternative mix I've mentioned earlier on in my presentation, when you look at how Ghana bonds and equities have moved over time in the last 10 years, it is undeniable that actually, once you have equities in the mix of your bond equity holdings, you actually get the actual correlation pinned right. It's a benefit. The only benefit it gives you that it just reduces your risks, right, in terms of market in terms of market prices or uncertainty. So when you look at alternatives mix from commodities, real estate, Bitcoin, gold, hedge funds, and the private equity, when you look at the correlation with our equities on our with the Ghana bond and equity mix, you realize that there is a very low correlation with these alternative assets. And then in adding them to your portfolio mix will actually give you the sales pitch of the alternative number one, which is the correlation argument. So when you look at the last decade, we try to run a couple of scenarios just to look at how it would have been, just to give you a view of what happened. Just in case you're actually playing only in the Ghana bond and equity market, and regardless of the mix that you've had, whether you held 10% of bonds and 90% of equity, or you've held 20% of bonds or equity 80%, or if you were very risk averse and you're holding more of bonds, 90% of bonds and equity 10. But in a normal typical classic way, which when you look at the divide, mostly 60-40 for people who are really trying to preserve capital, not trying to really take, with the argument that maybe if we take on more of these alternative classes that I've mentioned, you may be taking on rates that you are not really interested in taking. But when you look at it on the divide and the scenarios, you realize that even if you were being this conservative and a very capital preserving mindset, and you've allocated maybe just 60 to bonds and 40 to equities, and these are Ghana bonds and equities, that would have given you a better return in the last decade, and then with a low volatility mix. And that is because even though we've had a little bit of volatility in our bond market, but when the equity market started picking somewhere, as I've shown earlier, somewhere from 2020 all the way up until year to date, we realize the equity market has been on a bullish run, and that's why you've seen that the volatility in that aspect of the divide is not really pushing, it's not really that high, but offering the maximum return. Let's put this in perspective. This is just only when if you're playing in the bond and equity market. But once you add alternatives that I've mentioned, which are my green dots, the green dots are actually all the portfolios that have infused a little bit, 10% of alternative into, which are the various alternatives: commodities, real estate, gold. If we're having a hedge fund market that would have been active, and then being also, if you're having a very active private equity market, that should have given you the opportunity to allocate capital to just 10% of that, whilst reducing your. This is done in the case that maybe you just wanted to hold bonds and then preserve capital, not really want to take in a little bit of risks, but just playing a lot more in bonds and less in risky assets. You'd have allocated just 10% infusion. But we've seen what has happened, right? All our portfolios that have been infused with an alternative mix with just 10% have outperformed those who have been in the bond equity mix for a very long time, over the last decade. Just to put this in perspective, right? When you look at this table, it just gives you the actual return, right? It is not surprising that when you infuse these alternatives into the classic bond equity mix, or if you're playing the bond equity mix, you've added a little bit of these alternative assets that I've mentioned into your portfolio, it is just no brainer, right? And it's crazy. When you look at the return it's offering, Bitcoin, I mean, we all know what Bitcoin did to all asset classes, right? It has been on beating run for a very long time. When you look at, if you have added 10% of just Bitcoin to your portfolio, it will have given an annualized return for the last 10 years of 26.2%. But when you want to really look at it on a rates volatility adjusted basis, for every 1 unit of rates you would have earned more if you've had an alternative mix into your portfolio than playing in the bond equity market. And then this is the first sales pitch I was talking about, that if you add something that is less correlated into your bond equity mix, you will have had a little bit of benefit, which is kind of like in terms of return. But this is just to put this in perspective. From 2015 all the way to 2020, the bond market and the fixed income market was having a good run, because at that time macros and everything was stable. But when we go to 2020 up to 2025, we've seen what happened with FX, with the bond market, with all the volatility, the crisis that we faced. But just to put that in perspective, if you were playing in the alternative market or had a chance to play in the alternative market, which is just 10% exposure, whilst reducing your classic 30%, 40% equity rates to just 30 equity and then 10% of alternative. It's even surprising that if we are playing in all these alternative markets, Bitcoin, gold, having the hedge fund ability, also in the private equity and the risk market, as well as the commodity market, you have performed even better than holding single alternative you have performed better than even adding a single alternative to the mix. And then the next argument for alternative sales pitch, which is normally the alpha argument, assuming that you are playing in these markets, you'll be able to actually generate something that the normal classic bond equity mix players wouldn't have earned. But when we look at it from the data, from the analysis we've just had at the top all the way down, when you look at, even if you were in having the same view of saying that, okay, maybe you wanted to preserve capital, you're doing the 60-40 that we saw had a better run in the last decade, in the last 10 years, in the earlier slides, right? If you've used that as your benchmark and you've introduced a little bit of alternatives into your portfolio mix, you've realized that it's evident, right? Except if you're holding cash, that you wouldn't have made an extra return. You'd have made roughly what the classic 60-40 would have done. But if you had a little bit of alt in your alternatives, in your 60-40, using your 60-40 as your benchmark for the last decade, you would have earned an extra return, about 9.7% extra return if you've had 10% of just Bitcoin. And then if you've had almost a little bit of every single class of the out of alternatives that I've mentioned earlier, you'd have had an extra return. And it's evident and it's no brainer that I mean these are biased to the time period used and also the portfolio mix, but just to give you a view what would have happened if you're playing in that market over the last decade. And the last argument or the last story that I've entered the mix and then I've pushed for the reason why investors or funds allocators or fund managers should look at allocating capital beyond the actual bond equity mix have been the impact argument. For this particular part of the market in Ghana, it's really extremely difficult to come by the actual data to testify to what the impact has been over the years. But the Ghana Venture Capital Trust Fund have done a good job. They've given us a little bit of view and an exposure in their annual report. And then I'll just want to run us through. For here is for the returns and the exits, the successful exits that have happened. It is not really that public, or maybe the information is not really that really publicly available for us to use in our analysis and testify to the good or to testify to the impact story that have been preached by the impact investing universe and the social good investing universe that are promising not just returns, but also the impact these kind of investments or asset allocation or fund allocation that would have had if it was being in place. So we're going to rely on a few information that we've had from the Venture Capital Trust Fund. So when you look at over the last from 2004 all the way to 2024, what the data we've had about 14 venture funds that are primarily active in Ghana as of now. And then these 14 venture funds have invested in about 77 companies. And then when you look at the funds that have been committed so far, about 359.6 million have been committed to this impact story and this impact landscape. And then when you look at the committed funds from government, but when you also look at for every For the 259.6 million that have been committed by government, other investors have also pushed up the amount, have also pushed up this amount to almost 2 billion in funding from other investors. That is just to show you that we have an active venture funds market. It may be subtle, it may not be all over the place, but for the information we have, we've seen that maybe for their successful exit, and there's a better payoff also in this side of the market. And then we may be saying that maybe it is a time for us to start having conversations on to bringing this side of the market into the mainstream. And when you look at the market so far, this is just an overview also from the Venture Capital Trust Fund, showing us the notable fund managers that are existing and active on the market. You can see Oasis Capital, Injaro, Wangara, Mirapa, and then Impact Capital Investors. And then these fund managers have invested in some of these companies who may be familiar to you. And the general impact has always been that once you give out money, you're able to make the return, or the story has always been that once you're able to give out, allocate capital to these sectors beyond your bond equity, you've given to private sector. And this private sector is what we actually need at this point in time, because much of the growth we need in the economy is mostly going to come from this private sector. When we talk about the jobs, the taxes being paid, the taxes being paid to government being able to generate enough revenue, it's just going to come from an active real sector. And this active real sector needs an asset, an asset allocation. So funds being allocated to this side of the market. So when you look at just a general overview, just to close this chapter, when you look at they are saying that there's been a significant impact from the venture capital space of Ghana. So for we see, as I said earlier, about 359.6 million have been invested in these 14 venture funds that I've mentioned. And then with this, so for when you look at for every one cedi that has been committed by the Venture Capital Trust Fund, there's also a 5.58 cedis that is also raised from other investors, which brought the total amount to the 2 billion we are seeing here. And this 2 billion over the years have created about 28,486 jobs, both direct and indirect. And about 46.9 million were paid in taxes by these funds and the investee companies. Just to put this in perspective, if pension funds or fund managers have been given the free roll and also the flexibility to allocate more into these ventures or more into this space beyond the bond equity allocation, it was going to be a very, 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 very good run for the industry. If 14 companies, so if 14 funds, debt funds are able to generate about 28,000 jobs, if we've had a lot more of these on the market, these options for fund managers also being actively invested or capital also being actively allocated to this part of the market, it's very difficult to justify the returns. But when you look at the impact, it's really the impact is actually evident. And then I'm sure if the market was actively if the market was that active, we would have had a lot of information on the actual returns beyond the impact story we would have had. Just to give you a view, as I've mentioned earlier, these are some of the fund managers that are driving this impact together in Ghana. We have the GIP, Injaro, and then Mirapa and Oasis, and then other fund managers in this landscape that are driving this impact together. Just to wrap up and just to close, the idea of today's session is actually just to say that there's a universe of asset classes that are outside the bond equity mix, and then it needs attention. And also, not that it needs attention for attention's sake, but the returns, the benefit, and everything we've talked about is evident from our discussion so far. We also need that regulations also need to adjust to also to most of these new trends, market strategies that are coming into other markets. We need regulations to be able to really look into these areas and also try to see how best we can build the market up with some of those strategies coming up. And also, we also need fund managers also pushing for new products, right? Bringing new products into the market. As we've shown earlier, we've had ETFs, index funds, and tracking most of these asset alternatives that I've mentioned into the market. We are giving pension funds or maybe other fund managers flexible or easy access to some of these asset classes on the market. And then I think this is going to be the end of my presentation for today's session. Thank you very much for listening.
All right, thank you very much, Enoch. That was a great presentation, and we actually acknowledge how animated you were with your presentation. Thanks so much. So the floor would be open for questions and answers as well as contributions. But before we do so, I just want us to take a quick poll and return right away to engage in the Q&As and contributions. So there are just two sets of polls. I need to check them out and then just answer them quickly for us, and then let's have a discussion on what has been presented and then also attempt to answer some of your questions. So I have on your screens now the market update part, just 5 questions in there as you skip or answer and scroll to your right. So the first one has to do with trending lower yields. What's your biggest portfolio challenge today? We would like to know if finding real returns is your biggest portfolio challenge, or preserving capital, diversifying income sources, or timing the bond re-entry is what remains your major portfolio challenge due to the falling yield trends. The second question in this category has to do with the T-bill. So we would like to know from you if the yields we are seeing currently are sustainable in the long term. Thirdly, when yields drop, what do you typically do? Do you rotate into equities or reallocate your new funds into equities? Do you just shift duration preference? Do you move into alternatives, or you hold cash? Among these 4 options, which one would you go for when yields drop? And penultimately, when do you expect a broad re-entry into Ghana's bond market? We've seen that RFPs have been called for and proposals have been submitted. The government keep mentioning their desire to come to the bond market. But how soon do you think this is going to be? Within 6 months, 6 to 12 months, or beyond a year? And finally, in this chapter, which factor will drive bond demand recovery the most? Is it inflation, fiscal discipline, FX stability, or attractive real yields? Let's turn our attention quickly to the alternative side of the presentation. So what role do you see for alternative investments in your 2026 portfolio? Is it going to be a core allocation in your portfolio, or it's just going to have a satellite exposure, as in it's going to complement other asset classes or support other asset classes? Or you may rather treat it as an opportunistic play only when you see that opportunity arises in alternatives, that is when you will take a position, or you are not interested in alternatives at all? Secondly, are you interested in a Ghana-listed Bitcoin ETF if it's available? Is this something that you would want to include in your portfolio mix? Thirdly, in times of uncertainty, which do you prefer, gold, Bitcoin, real estate, or you hold your cash? If you scroll to the right, the next question is, how attractive do you find private equity opportunities in Ghana today? Is it very attractive or moderate potential, still too illiquid, or you are not interested in private equity at all? And then finally, which area of alternatives do you think will see the fastest growth in Ghana by 2030? Private equity or private credit? So private equity takes ownership, private credit only gives a debt, or real estate or crypto. Which of these alternatives do you think will see the fastest growth in Ghana by 2030? Okay, thank you very much. Now we can return to our presentation. Our presenter and a host of others are ready to share their contributions or attempt to answer your questions. You can raise your hand and we would call you so that you share your contributions or ask your question. In the meantime, we have a question in the chat box. So what can we attribute? This is coming from Grace. What can we attribute to the rapid turnaround for the penny stocks such as Clivestone, SIC, ETI, etc.? Well, Sandra, we don't hold a company view on the elements that might have resulted in the strong price gains in some of these smaller stocks. But on an analytical view, we have pockets of opinions that we think could be contributing to these turnarounds by a larger extent. On the macro level, as the presenter mentioned, the significant fall in yields this year have actually led to investors shifting into equities in search of higher returns, and hence, generally, that would boost the entire stock market's performance. In another view, we've also seen an increasing retail demand for equities due to various capacity building initiatives across the market, and then also social media influencers also doing their part, and easy accessibility through digital platforms. And these retail clients, they began with lowest price stocks, and given the thin liquidity of some of these stocks, the price will begin to rise, obviously. And with a relatively low base price, even little price gains could translate into higher percentage returns, as we see Clivestone, which reported about 100% double in Q1 2025 from a very low base. So if year-to-date performance charts is shown and people see SIC, Clivestone, and ETI up there, it further boosts its demand, hence causing some of these turnarounds or price gains. But I'm sure our presenter and some equity traders on the call may also want to zero in some specifics, maybe from dividend yield perspective and then also financial or operational performance perspective. Yeah, okay, so the mic has been allowed now. Sorry, the mic was muted, so we were getting some equity perspective. Okay, so Daniel, you can come in now.
Yeah, can I be heard?
Your voice is very faint.
Okay, give me a second.
It's getting better.
Yeah, is it better now?
Yeah, go ahead. We'll manage.
Okay. Yeah, so I think this year has been a very superb year for equities, as has been rightly said already. I think the question was mainly centered on the likes of Clydestone, SIC, and then Carbon, right? Yeah, so for SIC, I think the main conversation has really been around, government is trying to work out a new strategy for the way vehicles are registered when they come into the country, etc. And with the new structure that is being discussed, you can see that SIC as an insurer is in the mix of all of that. So that has really played into the rally that we have seen so far in SIC's movement upwards so far this year. It's not only being in that region, you can also see that it has trickled into almost every single government, in quotes, government participating stock on the exchange so far, with the likes of CPC also, which hasn't moved in quite a very long time, also seeing some very strong movement upward so far this year. For the likes of Cal, I think we've been here before. If you go all the way back to, I think, 2020, thereabouts, before even the DDP, price was around 70 pesos thereabouts. So we've been here before. Um, then at the time, if you look at what their book value per share was, it was way above 160 pesos. So yeah, that it makes sense that we are around this period. We went down mainly because of the negative capital adequacy ratios that we saw, and then also the very high non-performing loans that they had recorded. But then again, this market has always been crying for a market that is efficient, that listens to what is happening in the space, and over time, you can attest to the fact that we've seen changes in board members at CAR. We've seen a new CEO being elected. We've seen um, plans by management to, revamp what level of confidence that the market already had in CAR, because CAR was a very huge market darling even before the DDP happened and even before we saw negative NPLs, etc. But the likes of Clydestone, I think for a very long time within the ICT space, it had really been MTN that was moving the markets. But then again, this not just this year, we've seen since the past, since second quarter 2024, I think they had very huge numbers in terms of bottom line and then top line, mainly coming out of their EMV card sales. We saw very huge numbers also coming from the ATM sales as well, and then also some check crossing codes, etc. So then again, the market is being reflective of the numbers that they have seen, and mainly on the back of some research work that most market players have really been contributing to. So yes, the market is being efficient. They've seen the numbers, and like Ernest also mentioned, you see a lot of retail guys also um, coming onto the market because of some of the reports that have been sent out in recent time. Now for ETI, I think I'm talking about Cal, SIT, Clyde. For ETI, the market has been heading for most parts on EcoBank, right? And in the event where for most of the people that um, have come through our equity decks and looking for stocks to buy and having been able to get their hands on EcoBank for a very long time, they've decided to opt for ETI. If you look at the valuations also on ETI, look at their book value per share, etc. In the past 6 months, it looks very impressive. And the main reason why you can see the rally that we've seen ETI so far this year. So for most part, it's been on the back of research work that has been done, and then also the markets being really efficient. If you speak to other people on the other side of the argument, the conversation would be around the fact that most of the stocks that have moved this year have really been over exaggerated. Example, for instance, if you speak to people on GCB, for instance, we've seen it move very rapidly all the way from 8 up. Now it's about 15, 56 in terms of price. And just this morning, information came on the fact that they weren't going to pay the dividend anymore because of certain regulatory requirements that they had to meet with the regulator. So now we just have to sit and wait and see what happens on that. So those are my 2 cents on equities and some of the penny stocks that we are seeing. I'm not going to say what direction you should expect them to go, but if you've been on the markets for a while, you should know what the next 10 of events will be for some of these penny stocks that have moved this year. And thank you very much. I think you can take it from here.
Sure. All right. Thank you very much, Daniel. Our speaker, Enoch, would also have something to say on ETI. Enoch, you can go.
Okay. Not just ETI. I think I'll try to touch a bit of all the stocks that were mentioned. Can I be heard?
Yes, please proceed.
Yeah, so I'll start with Clyde, right? For Clyde, what we realize. Yeah, so I'm going to start with Clyde, right? Clyde, what we realized was that their numbers came in good this year when we were doing a financial analysis on Clyde. We realized that their numbers were good. And the reason is that they have expanded their customer base, right? It's kind of like a subscription-based IT company, right? It's people that subscribe to their to sign contracts for them to supply them with IT equipment, right? And then they've explicitly mentioned it in their annual report that they've expanded that base, that customer base. And then I think it was what the market read into and priced it in, and then it's pushing up. With SIC, what I think is that I think the insurance, the listed insurance companies are all actually doing well this year. And then I've always have this belief that when it comes to insurance, it's a function of economic growth, right? It's a function of where the economy is and the confidence in the market. If the economy is good enough and then there's confidence in the market, I mean, if it's good, what it means is that you have assets to protect, right? You are able to, you have extra, you have things you want to insure, and you also have extra to pay those premiums, right? And also confidence in the market, right? I think it's also a function of that. I think that is what is also spilling over into the listed insurance companies. And for ETI, for a long time now, I've been looking at it for a while. And when you look for ETI, it's actually dual listed, right? It's listed in, I think, about 3 exchanges, I think in Nigeria, Cote d'Ivoire, and Ghana. But mostly what I've realized is that in Nigeria, it is actually low relatively to the price it is trading at in Ghana. If you want to put both in one currency, dollar, to look at it, there's kind of like an arbitrage. So I think personally that there are some investors that are taking opportunity of that, and that is what is pushing the price so high. Because when you look at both the ETI price movement and also the in Nigeria and in Ghana, you see that it's kind of like highly correlated. Like they move almost, maybe they're a bit of lacking because of different markets. But what we've realized that recently, later 2024 all the way to 2025, the Ghana one has outpaced the Nigeria one in terms of movement. And then I strongly believe that there's kind of like an arbitrage advantage that some investors are taking on. Maybe the traders, if they have extra color on that, can come in and give that. And I think that will be, that is what I think on these three stocks you've mentioned. Thank you.
All right, thank you very much, Enoch. The floor still remains open for questions, and we have a couple of them in the chat box, so I'm also going to read them out and then attempt to answer. So we have a perspective which also closes with the question. I think most investors are often concerned about the extent of losses during market downturns in alternatives like crypto, and hence, given the unpredictability of these markets, how can investors be encouraged to allocate capital in that direction? And then we also have another question from Michael. So we'll read all and then attempt to answer. Another question from Michael. Is there a regulation on how asset management firms value their holdings in private equity funds? And then finally from Prince, it would be very helpful if we can get context on the constituents of the others profile of investors who raked in 15.68 billion net additions of equities trading volume.
Hello, can I be heard?
Yes, you can be heard.
Yeah, I will start with the unpredictability of the crypto market and all of that. So as I've showed earlier in the chart, if you're playing in the Ghana market as well as sorry, let me just read the chart to illustrate that. As I've showed in here, if you're playing in the Ghana market, also playing within the bond equity mix, and then for those that were playing the bond equity mix, and then those who have added maybe. By the way, this one only is kind of like it is the crypto is a crypto here, which is the Bitcoin when you add it to the portfolio mix, right? So when you look at it, so your x-axis is your volatility, and then your y-axis is your returns, right? So when you look at the volatility, if you're playing in the Ghana bond equity market, with what that have happened in the last decade, what you've realized is that most of the mix, about three of them, actually the volatility of the three of them actually outpaces the volatility of what even happened in the crypto market. With the crypto market infusion actually giving you a better return compensation for the risks. Just to put this in perspective, right? So for every 1 unit of risks you have taken playing in the crypto space, and I'm using, well, this may be biased because I'm using only Bitcoin as my guinea pig here. So when you look at an infusion with Bitcoin into your portfolio, for every unit of risk, you have earned 1.63 return on that, which should have compensated you more for taking up that volatility risk than those who were playing in the Ghana bond equity market. And there are two ways to this, right? It's either the volatility, when you look at it here, it's really clearly explained here. The volatility of about 3 portfolios, if you're playing only the Ghana bond equity mix, would have given you a lot of headache for no reward. But the crypto market, even though it was going to give you a little bit of, not be a little bit, it was going to give you headache. The volatility is there, but then the return or the payoff would have compensated you for that. It depends on what you want to choose. You can't spend volatility, but you can spend return. You may just have to try to live with the two. Yeah, and then so for the second question on the investors, an idea on the investors that work in. Sorry, let me move to that chart.
Yes, so it will be very helpful if we can get context on the constituents of the August profile of investors who raked in 15.68 billion net acquisitions of equities trading volumes.
Yes. Hello, can I be heard? Can I be heard?
We can hear you, but it seems your voice is a bit delayed.
Hello, can you hear me?
Take it. Yes, go ahead. Go on.
Okay. With the investors in the other category, it was really something that I actually called CSD to find out on the specifics of this, but unfortunately I couldn't reach them after several attempts, because it was kind of like a bit interesting to actually know what happened, because I've realized that when you look at between June of 2025 and August of 2025, some, according to CSD, some investor class of people actually divested their whole positions. But I think maybe it is kind of like those that were showing that they actually 100% let off their holdings. Maybe that was actually added to the others in the 15.68 billion. But since I was not able to actually have a conversation with the people at CSD on this particular matter, I can't emphatically say that the others comprises of the firms and institutions that divested 100% of their holdings. But maybe I think maybe it is not added to them individually as that investor category, but maybe what they held was in here. Or if it is true and the data actually show that what the data is showing is actually a true representation of what happened between June and August, it could be that the other investors, maybe, I don't know if it is private kind of transaction that happened, and then we're not really categorized. But I think if it was institutions or pensions or the banks, we would have known as the banks and the firms and the other foreign investors and then individual investors, and then the pension funds were actually individually categorized and well apportioned. If it is none of them, it may be some private transaction that might have happened that the shares were moved from one entity to another, which was not classified under any of these. Yeah. And the third.
Yeah, Michael. So I'm trying to find that directive publication and just post it in the chat box. But in the meantime, I think you can make use of this. So there's a SEC directive that is actually titled Directive to Market Operators on the Use of Fair Value Through Other Comprehensive Income or Mark-to-Market Valuation Method. And it actually applies to portfolios of collective investment schemes which fund managers manage. And in that directive, it covers both listed securities and then also provides guidance on unlisted securities. For the unlisted securities part, where that is where private equity would find itself, it actually mentions that such unlisted securities shall be valued periodically, taking into account market movements, contractual cash flows, and then recoverability of the underlying assets. But if I'm unable to find it before the call, and you can just send me a hi on WhatsApp or send me an email, I'll find that publication and send it to you. I have it. Sure. Any other questions or contributions based on what has been presented today? And I'm sure you can also go back to the polls and see. Okay, all right. We have Mensa Belly Abraham. Mensa, you have your hand up. Your mic is already allowed. You can proceed.
Okay, thank you. Thank you very much. This is a very insightful presentation, and the presenter did a very good job. One of the things that drew me to this was to see how, as alternate players, we can actually position this in view of the current happenings on the market, or as somebody said before, the market government became sexy again. But yesterday I was in a meeting with one influential member of the capital market in Ghana, and he made an interesting comment, which I think is necessary for us alternate players to consider. He said that, oh, as for alternate, we give you some monies because we want to diversify. We are yet to be moved by the level of reporting, the level of impact, and the level of return that is verifiable. I found it interesting to the point that I think that, as the presenter stated with the venture capital report, we may have to consciously start, even though it's private equity, especially on the private equity side, we may have to consciously start reporting returns and, in fact, reporting bad news as well, so that we can be able to make reference to verifiable, peer-reviewed report and say that this is how the market has performed, this is how the market is performing. As it stands, it sounds like, because it's private, a lot of information is still private, which then hampers the growth of the general alternate market with regards to Bitcoins and any other such new developing alternate. So I think that I don't know how that can be. It can be a call to action for us interested parties to start putting together data and start reporting, especially at least on the Ghanaian space, because many people seem to be wanting to wait to see what has happened before they can put their foot forward. Thank you.
Thank you very much, Abraham. That's actually a positive call to action. May we know which company you belong?
Stanbic Investment.
Okay, all right, that's great. Thank you very much for your perspectives as well. Any other contributions? Any questions? Okay. All right, I believe today's presentation has been very helpful, a lot of insights and key takeaways. Me, if there's one thing that stood out today, I think it's that the investment landscape, as we all agree, is shifting. And as yields compress and traditional assets also move in sync, the classic bond equity mix, which our presenter spoke about, offers less diversification than before. And so alternative assets is actually gaining momentum or attention. We are talking about private credit, private equity, real estate, among others, are emerging as valuable complements. And so we should also be looking at them, since they offer uncorrelated returns, potential alpha, and even social impact, if you are considering the likes of renewable energy sectors and all of that. So clearly, pension funds, asset managers, and other investors would have to pay some attention to the alternatives. And like Abraham said, we shouldn't allocate funds merely because we want to diversify, but we should allocate funds because we see opportunities in there which we would want to take advantage of. Thank you very much, everybody, for joining today's call. And we thank you. And if you have any business that you would want to conduct with Blackstar, our doors remain open on the asset management wing. The global markets desk, as well as the IB team, is ever ready to engage you in any of our products and services. Thank you very much. Those joining us for the first time, Market Color is actually hosted every third Tuesday of the month. And like I mentioned, it's a platform that brings level-headed individuals and market participants like yourself to discuss current trending topics on the market for us to see how best we can all improve our markets. I hope to see you same time next month. Enjoy your month. Thank you very much, and bye-bye.